Hello everybody, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion on the local, national, and global economy and how it impacts your personal financial health and wealth. And now here's Taking Stock episode number 76 with Art Jarvis. Art, welcome back.
Hey, how you doing, Chuck? Good to see you.
Good to see you. And you're doing well?
No one's told me any different, so yeah, I'm doing fantastic.
There it is. Despite the heat wave.
Yeah. Guess what? The way I look at it is it's going to get hotter. So.
Well, there you go. Well, here we are on this last day of June, Tuesday, recording episode number 76 of Taking Stock. And yeah, it's probably still going to get hotter.
Yes.
So we're going to be okay. Oh, and like Father Larry said at St. Columban, I hate the winter, so this is good.
This is good, man.
It's not cold. It's nice and warm.
I'm an equal opportunity complainer. I make this statement all the time. When it's hot, I'll be complaining about the cold down the road, and if it's cold, I'll be complaining about the heat. So,
well, I want to remind everybody of a way to beat the heat. So we're going to dive right in to Taking Stock, and they can figure out what that means. Dive right in, cool down a little bit with some financial talk, some investment talk, some economics talk, how's the economy going and whatever's happening. But here it is. You said you're an equal opportunity complainer. So Art, who's complaining? What's the fear? What's the greed? And what's the uncertainty driving the market on this Tuesday, June the 30th?
I still think the biggest uncertainty is still over there with Iran. I'm not sure it's ever going to be a done deal, but but things have gotten substantially better, just like in the last 4 weeks or whatever. Oil was probably at $70 a barrel. Today it was actually down below $70 a barrel, and then they started blowing things up again over the weekend. So gas prices went up. Oil didn't move that much, but interesting enough, gas prices went up about 70 cents a gallon.
and you know what? This is my question, because I think that's the greed. Yeah. When I said, what's the fear, what's the greed, what's the uncertainty? So the greed is at the gas pumps. Yeah. Because as you just stated, I knew that the price per barrel was at the 70. Mm-hmm. It was low 70s and all the way down to 70, and now you said it even dropped slightly below to $69, $68 a barrel or whatever. Yeah. And yet, the gas pump went from $3.35 in my neighborhood, which was always a little bit higher than your neighborhood for whatever reason, as we talked the last 6 or 8 weeks. It was $3.35. Yeah. And then the next day I go and it's $3.99. And then it was $3.89, and then it was $3.79, and it's somewhere in that neighborhood, $3.69, $3.79, as we sit here and speak on this Tuesday, June the 30th. And so that's the greed factor, Art. Yeah. Is it not?
Yeah, because I know I paid like $3.17 a gallon when I filled the car up, and then we went on a little trip and had to come back. I had to fill it up again, and yeah, you're right. It was $3.80 something. So my bride, she mentioned something about it, and I said, well, it's not the oil prices. The oil prices haven't moved that much, but it's...
Well, usually when we talk about the greed factor, we're talking about investors driving the market with their greed or their fear or whatever. In this case, it's the corporate greed. Yeah. The oil company.
And don't forget, we've got the 4th of July weekend coming up, so what's that going to do to gas prices?
$4.19 a gallon.
Yeah, so...
Just, mark that spot on this episode. Chuck said $4.19 a gallon this weekend here around Loveland somewhere.
So ridiculous. They can continue to play with the gas prices, like they always do, but... as we talked, petroleum goes into a whole lot of other things, so I'm happy. I made the mention that I would really like to see oil down below 80, and then we actually got slightly below 70, so again, that kind of makes me a happy camper. And there's a lot of numbers, the inflation numbers, like your favorite, the producer, I'll shoot it, is that right? The consumer expenditure inflation index came out, and it was it was still above 4%, but it was actually 1.1% less than what they were expecting. So the market took that in stride, and they were happy with that. And, and then there was some talk that, our gross domestic product, was working its way down, and people were getting scared. But now, hopefully, some of that fear and some of that consumer expectations and things is starting to increase. So, hopefully, we'll actually see that gross domestic product start to move back up into maybe the 2 or 3% year-over-year return. So that would be a very good thing. But the crazy thing is today is June 30th. Right. So we're ending today the first half of 2026, and we've been all over the place, kind of like last year. But oil prices compared to the beginning of the year are actually down about 2% from the beginning of the year. So interesting enough, we shot up to $125 a barrel or whatever it was, and here we sit today, year to date, oil prices are actually down 2%, but guess what? Gas prices are nowhere near down 2%.
No.
And I didn't even do that number, but it's a double-digit number, though.
Let's draw on our memories here. Yours is probably better than mine. So January 2026, what were we paying at the pump? February 2026, what were we paying at the pump? Because then March came, Iran conflict came, and things changed.
Yep.
But what the heck? What were we paying? I mean, we were like two.
It was probably behind 275 to
I was going to say
somewhere in that area.
I was going to say like at least as low as at least 289, if not below that.
It was below 3.
Yeah,
that I'm pretty certain about.
And it jumped to as much as I know that I saw. What was it? $5.35 a gallon at one point. It was and that lasted for. I hate to even mention that number because it was over $5, but it was over $5 here at the corner near my house for like a weekend.
It wasn't,
and it wasn't
even a week. You're right.
It dropped back down. It was still ugly, but the point is we'll say from 275 to 535, and it stuck around. We'll just say like 490, 485 in that neighborhood. Yeah. So
So to your point, oil is down a couple percent. Call it even if you want to, but gas is up about $1 a gallon.
At least.
Right?
Right.
And so don't blame it on oil, and I don't think anybody increased any taxes recently on it. So why is gas $1 per gallon higher when oil is basically where we were, or actually slightly lower? So, to your point, but even that has settled relatively quickly. But then you look at the stock and the bond indices. As of today, the S&P 500, which is kind of our U.S. large cap index, is up 8.7%. So in spite of the fact that we dropped in February and March, here we sit at the end of June, up 8.7%. The other thing that is
that like year? How do you?
That's just straight 8.7% from December 31st until June 30th. So so if you extrapolate that out, an analyzed number would be 17 point something percent or whatever. Yeah. The interesting thing is and this is switched. It didn't start off this year because it was still tech stocks leading the way, but tech stocks have really been getting beat up here over the last few weeks. So now if you take that S&P 500 and unweight that index, so take all 500 companies, give them an equal weighting, the S&P 500 equal weight index is actually up 10 to 11%. So the average stock is now for year to date actually outperforming the weighted index, and then that again has everything to do with technology stocks and stuff. But you look at the small cap index, the Russell 2000, it's up 21% so far year to date. Yeah. So it's been doing well. And then the other thing is if you look at International stocks are up around 14%, and in emerging market stocks are up 25 to 27%. So, two things have happened. We've seen a little bit of a switch now where some of those neglected U.S. stocks have started to move forward and perform better than technology, but also the international sector, which got a nice start last year, has continued into this year. I mean, it's doing 3 times what the S&P 500 is doing. So.
What's the rocket ship in the emerging market? You said they're up like over 25% or in that neighborhood.
That's a great question. I don't know the answer to that question. I don't know what the leader is in that pack. Yeah, off the top of my head anyway. But so it's been an interesting year, and I'm sure it's going to stay interesting. But we've seen some volatility, but yet we're sitting here on June 30th, and generally speaking, we're doing okay. I'm sure we're spending a little bit more at the grocery, and we're definitely spending money at the pump. But our housing values have continued to move up. Our 401ks have continued to move up if you're in the right stuff, which, bonds have basically done nothing again this year. They were worthless last year, and they're worthless again this year. And that worthless is not a fair term. They're still they're still paying dividends and things like that. So maybe you're making if you buy a 10-year right now that's yielding just say 4.3%. So if everything remains equal, you'll get 4.3% out of that treasury. But that's half of what the S&P 500 is doing, and that's sixth of what some other indices are doing. So
I have kind of a twisted question winding its way through my mind right now to ask, because essentially, like you said, regardless of the volatility and what has happened these first 6 months of 2026, here we are, generally higher value, up the mark. Everything's up, and so everybody's investment portfolio should be seeing some increases.
Definitely.
So the twisting, winding question is. Is it possible? Basically, okay, so people can look. I glance at mine and I know it's up, and it's like I'd like it to be up more. Who wouldn't? But hey, it's up, and despite all the things that have happened, I've had gains. So everybody looking at their portfolio. That's spreading that term really wide. Everybody, but anyway, people looking at their investment portfolio should essentially see that there's been some gains. So at the end, it's like, what's the problem if somebody's looking and seeing a portfolio where they're not seeing gains, where they're experiencing up year-to-date 2026 losses? How does that happen?
That's you have to try hard. is the answer right now? Because I just rattled off. Large cap stocks are up 8%. Small cap stocks are up 15%. International stocks are up 12 to 27%, depending on what you're looking at. Bonds, they're flat, but they're not down, right? Flat or up a percent or two. So you have to be in the wrong international countries first of all. If you're a individual stock picker, you might want to reevaluate the individual stocks that you're picking. So, this is one of the,
But people's investment portfors should be showing gains. And it would be fair to say then also, if you are an individual who's investing and you're not seeing, if you're seeing loss, not just staying flat, because that, whatever. But if you're seeing losses, you need to take a serious time out with your investment advisor, yes?
100%. And maybe go
call Art.
Or maybe go talk to another one and at least get their input on it. And, I tell people all the time, I don't have to manage your money for you. If you want to show me what you got, and I'll give you my 2 cents. You can take it.
Good, I'm up 2 cents.
Well, yeah, well, it's a penny and a half maybe. But I'm always happy. But again, it's what I believe, there's thousands and thousands and thousands of investment advisors out there. They all don't look at the world the same way I do, and I definitely don't look at the world the same way they do. I'm much more aggressive. I will admit that. Every single time you ask me, I've got clients in their 80s that don't have a single bond in their portfolio. Now, that works for them because of where they are in life and what, their risk tolerances, their liquidity needs, and their time frame, right? So they don't need bonds in their portfolio, okay? And they've done exceptionally well because of that. But you walk into some places and they go, hey, Mr. Jarvis, you're 60 years old, so you should have 25, 30%, 40% bonds in your portfolio just because of my age. Well, no, there's a lot more that goes into it than that. So, but yeah, that's a very long-winded way of saying, if you're down so far this year, you might want to just kind of reevaluate and have a discussion. I would. If the markets are up 8% and I'm up 7%, okay. I'm not thrilled about it, but I'm in the ballpark, right? If the markets are up 8% and you're down 5%, I'd reevaluate. Like that, you're not paying me good money to be that far off, right?
Yeah. Well, even if the market's up 8 and you're down 1, you don't even have to be down 5. I mean, that's what the heck is going on? Why am I down when the whole market is up? But the bottom line is, we could say to listeners right now, if you go, hopefully a lot of people are in a position at this point, whatever stage of their life, where they're letting whoever their advisor is handle their accounts, and they're not freaking out every day looking to see what's going on and driving Art Jarvis and company crazy with phone calls like, well, why this happen? You don't need to know that 24-hour thing. But the point is, we could tell them right now, hey, if you want to take a glance at your portfolio, you're going to be pleasantly surprised. Well, not necessarily pleasantly surprised, but you'll be pleased with the results showing, gains in what has been a volatile, 6 months.
Yeah, 100%. I mean, again, I have a whole array of clients, right? Some are more conservative than others, some are more aggressive, but I can say with pretty good confidence that the average client for the last 12 months is up 20-something%. Okay, and if I look at them from the last 3 years, their average annualized return is somewhere in that 17 to 20% range. So they've been making 17 to 20% per year for the last 3 years, right? So that's what and I'm going to say these words. I'm not some great big genius, okay? It's running a diversified portfolio and being in the right sectors. But the markets have been like you're saying, the markets have been very good to us, at least for the last 3 and really more the last 4 years.
Yeah.
If you're down or if your returns are substantially different than what those average returns have been, then I would look at it. Because then the question becomes, well, that's great. The U.S. market's averaging whatever the number is, 17% per year for the last 3 years. But you're sitting in 75% bonds. Yeah, your number is going to be substantially less, right? And maybe you should be 75. Maybe you're that person that, the market went down 20% last year in February and April or March, and this year we went down 8% in February, March, and you can't sleep at night. Yeah, you shouldn't be. Yeah, so it's also your personality type. But once again, to your point, it's worth a conversation. Yeah. Okay. Why am I so far behind? And some people, honestly, some people are at a point in their life where they're able to generate enough income off their portfolio, if they need any at all. So they're bringing that in, and yet they're still running a very conservative portfolio. But that very conservative portfolio is taking care of them. So there's a lot to it. Let's be clear about that.
And this is very generalized. I'm going to ask you to answer it anyway, without getting into all the details. So the most conservative client, whoever that, whatever that profile is, that you say this is my. This person has to be the most conservative. That's going to be the best options for them. What does that most conservative portfolio look like? What do you do for somebody that really needs to be? They're at the age where it's like they have basically a zero risk factor, zero risk tolerance, and they, they're whatever it is. If they're 75 years old, and it's like you don't need to have any losses. Let's just your portfolio is kind of nice, so let's be very conservative and protect it.
Sure.
That's the word I was looking for.
Yeah.
Somebody who's in that total protect mode and needs to be the most conservative. What is that portfolio look like?
Yeah, it could be one of two things. I mean, the what I call hyper conservative is you stick them in a money market fund that's yielding 3.8% or somewhere between 3.5 and 3.8% right now is generally where they are.
Okay.
So yes, that portfolio should go up every single month, a little bit, right? You shouldn't have a down month in that portfolio because you're basically investing in hyper short-term like investments like treasury bills and overnight agreements and purchase agreements and things like that, very conservative things, and they're running it in a money market fund. But the thing is let's say the money, but then here. So we go. I'm take a breath through my head, but yeah. But so the other alternative, which would still be very, very conservative, is I go into your portfolio and build a ladder portfolio of bonds and things. So I'll buy a 1 month, a 3, whatever it is, 1 month, 3 months, 6 months, 9 months, 12 months, depending on why they're being. They might be being conservative because they know they need that money in 6 months or something like that. So we can do a little bit better than a money market fund.
Well, that's the part where I struggle with the question, was trying to define whoever that is, and because it could be a variety of different reasons why somebody needs to be in protect mode. Yeah. Like you said, it may be because they know, like you said, in 6 months down the road they're going to need to pull out, and so that money we can't lose it. It has to be there at least. Then if we make some on it, that's better. But if it's whatever thousands of dollars or tens of or hundreds of thousands of dollars that they know they have to have. That's a
great example. Someone was I'm going to use random. It sounds like big numbers, but someone buys a $500,000 house. They're building a $500,000 house, and they're going to put 20% down. They need $100,000 somehow, some way. They have built up $100,000 or very close to $100,000. They want that money still working for them for the 6 months and growing, but they don't want to lose it because they need that money 6 months from now to put down their down payment, right?
Perfect.
So that's a good example. So even they don't care. This is their money for their house. This isn't their retirement money. So they need that money to be there 6 months from now. So you want to run a very, very conservative portfolio.
So one choice, as you described it, is the what did you call it? I don't want to say the bond market, but the money market.
Yeah, money market.
Pretty much 3.5 to 3.8, or 2 is at least your strategy would be build the bond, the one what is it, 1 month, 2 month, 3 month, or
whatever it ends up being,
1 year, 2 year, 3 year, whatever.
It might be 2, it might be up to 2 years or something. And all I'm doing in your portfolio is doing the same thing they're doing in the money market fund.
I got you.
Right? The only difference is I'm not charging you 0.5% to do it, okay? If you're making 3.75%, I'm not going to charge you 1%, then you end up only making 2.75, right? And I'll charge you a 0.25%. So if you make 3.8, you end up with, 3.55 or something like that. So
a quick look, and we got about 5-6 minutes left. So a quick look at the opposite end of the spectrum. You've got that client, and I'm going to suggest, and you can turn the client profile into whatever you want because you know how that works. But I'm going to suggest you've got that young client, and he's got basically his whole working life in front of him, and he's smartly getting in now at a young age. And so it's like, let's be aggressive. What does that portfolio look like? I kind of have an idea, but I want you to tell the listeners.
It's funny. So you use the word aggressive, right?
Right.
So
be 100%.
If you walk into XYZ brokerage firm and you say, "I want to be aggressive," when they hear "I want to be aggressive," that means you want it to be 100% stock.
Okay.
So, they put you in some S&P 500 stocks, they put you in some international stocks, they put you in some Russell stocks, they put you in some small cap stocks. You're 100% stock. And that, to people, some people use that's the word aggressive, okay?
Okay.
To me, I'm not sure what the real world word would be, but to me, it's you being where you should be, okay? It's not, it is aggressive. You have to worry about the volatility.
Well, that's why I said that client profile, you describe it.
Yeah, but if you're trying to go from A to B and you have a long time frame, as long as you can sleep at night with your portfolio bouncing around, you're going to, historically speaking,
Art's arms spread wide.
They're spread wide.
Yeah.
This is the big fish, right?
A long term.
Yeah, you are going to, and if you look at 20-year periods, and I just looked at this a couple weeks ago, historically looking at 20-year periods, the worst 20-year period was in the 60s and involved the 60s and the 70s, and it still made 5% per year. That's the worst 20%, okay? Right now, if you look at up until 2026, we're averaging 13% per year for the last 20 years, okay? And I always say the average is somewhere a little bit slightly higher than 10% in an aggressive all-stock portfolio. So as long as you've got that time frame and you have that mindset, you want to be aggressive. Now, there are ways to be much more aggressive. Okay, now you're talking about really being, in my opinion, being aggressive.
Well, that's a different definition because now it's not just, I want to be aggressive. It's like, hey, I'm good with risk and loss.
Yeah.
So that's somebody who has a high risk factor.
Yeah, so you talked about earlier, the hyper-conservative person, I call that basically going 0 miles per hour. Okay.
I got you.
And then we go to 100% stock. I basically consider that 100. So I tell people you can go 0 miles per hour, you can go 100 miles per hour, you can do a whole bunch of things in the middle. But you can also do 150 miles per hour. You can do 200 miles an hour. You can do 300 miles an hour. Okay. So you're talking, and there are investments out there. There's exchange traded funds out there that are 1.5, 2 times, and 3 times leveraged. So I can go buy the S&P 500, but let's say, it's the end of April and the S&P 500 is down 20%. I'm thinking, okay, this market's looking really, really good. I can take a portion of my portfolio and I can buy a triple leveraged S&P 500 exchange traded fund. So if the U.S. stock market S&P 500 goes up 10%, that security should go up somewhere around 30%. So now you're really, but guess what? If the market drops 10%, that portion of your portfolio drops 30%. So you got to, that's why I look at these things that, I'm not sure I should call it this, but I'm going to go ahead and say it anyway. I call it juice in the portfolio. Okay? You get in, you catch a quick rise in the market, and instead of making a normal return, you make double or triple that return, and then you take your profits and get out and go back to normal. Okay? And you started this conversation, so
okay, blame Chuck.
But there's also inverse leveraged security. So if you think the market has been killing it and you think the market's going to drop 10%, you can actually buy a security that's basically shorting the market. So if the market goes down 10% and you buy a triple inverse leveraged security, you make 30% or close somewhere around 30.
I got you.
So there's your conservative, there's your aggressive, and then there's what hyper aggressive, right?
And hyper conservative.
And hyper conservative,
yeah.
So those are great questions. There's so many things that you can do in the markets, and that's one thing people always say. Hey, I'm switching jobs. I got a 401k. Should I just leave my 401k where it is? Or should I move it and roll it over into a rollover? I always say roll it over into a rollover IRA because instead of having maybe 20 options that fit your risk profile in the 401k, you have 10, 20,000 other options available to you if you roll it over into a rollover IRA, and now you can buy whatever security you want to buy, not just these 20 that they're offering you. So that's why I'm I always say if you can't beat a 401k, you might want to find something else to do. So, in my opinion. Now,
Go ahead.
no, well, I just wanted, you asked a very good question, and I want you to get your money's worth, okay?
Fair enough.
So you asked me who's been the leaders in the emerging markets.
I got you.
So the top one so far is South Korea, and it's up like 70%.
Wow.
So yeah, and then you can follow that with like Taiwan, Thailand, Colombia, and Brazil.
Yeah.
Those are the top 5. So those are the ones that have been leading the way.
I was surprised because you shared with me, via email, either within the last week or certainly within the last 2 weeks. I forget what day. Every once in a while, Art sends me these things, folks. And I was really shocked to see some of those, emerging markets.
Mm-hmm.
I didn't necessarily look at the numbers, but I was like, wow, South Korea and so on. It was kind of interesting. Thailand, I don't even think about them.
No.
I just don't.
But that's a perfect example of you have what I would call just a normal, plain vanilla aggressive portfolio.
Yeah.
But we could add some emerging markets to it, and that's going to make it more volatile than a normal one. But also hopefully increase your returns too if your timing is good. So there's another good example of maybe now instead of going 100 miles an hour, you're going 105.
All right,
So.
30 to 60 seconds. Recap of the good news, not recap of what we just covered, but recap of the good news and what's going on. So I'll start it off and I'll say, people can look at their portfolio right now and see gains.
Yes. If you look, so you should get a statement in the next week or two.
Okay.
And in my humble opinion, it should be up for not only should it be up for 2026, it should be up really nice for the last 12 months.
Very good.
The last 12 months, if you're running an all-stock portfolio, if you're not up 20-something%, you might want to reevaluate, in my opinion. So now there's some investment advisors who are going to go, hey, I know what he's talking about. And it's like,
I'll call you.
of course, they're also the ones who are making less than 20%, so that's fine.
Well, my lovely bride, Sue, and I met with our investment guy last week. So we got a pretty good idea where things are at and did a couple of things. And, then I got this other, investment advisor that I sit across from every couple of Tuesdays now. And he's going to keep me updated, whether I want to be updated or not.
Oh.
But for today, and for our listeners, number one, thank you, listeners, for joining Taking Stock episode number 76. But first and foremost, Art Jarvis, thank you for coming once again, sharing your insights. I thought it was fun today, especially at the close.
It's a positive message.
Well, I think it's fun when Art sits across from me and says, "That was a good question."
Yeah, that was a good question.
Because I'm surprised when I ever ask a good question.
Well, and I hate to say, I don't know.
Well, anyway. But another, a little housekeeping for the listeners. Normally we'll say until 2 weeks from now.
Yeah.
Well, it's summertime.
Summertime.
And Art Jarvis and Chuck Gibson are going to take a little summer hiatus. So we will rejoin you not on July 13th or July 27th, but in August. Somewhere around 11th, 12th of August, we'll be back with the Taking Stock episode number 77. But reminder, this was episode 76, which rang our 1776 bill, right. 250 years. So for everybody, have a safe and happy and fun 4th of July. Art, enjoy your 4th of July and the month of July.
Thank you. Appreciate it.
So again, thank you so much for joining us.
Yeah, happy to do it. And look forward to seeing you in a month.
We'll be back in August. For now, I'm Chuck Gibson, and that is Taking Stock.